I hate three stocks that I'm buying videos, not because buying stocks is wrong, but because most of them skip the only thing that actually matters. A stock is not a good investment because it's popular. It's good if it trades below intrinsic value and the business generates durable returns. That's the framework that I use when I train top analysts on Wall Street, and it's the same framework that I use when I deploy my own capital. Now, here's the reality. I recently bought one company under 200, another under 400, and a third at a level most people wouldn't touch. Three different entry points, three different risk profiles, three very different reasons for acting. Only one of these clearly fits the textbook definition of a great investment. One is priced close to perfection even at my entry, and one might not qualify as traditional investing at all. So instead of doing a lazy top three stocks list, I'm going to run through each of the only four filters that actually matter. Why now? What makes it wrong, what Wall Street may be mispricing, and what role it truly plays in a disciplined portfolio. Because if a stock isn't trading at a real discount to intrinsic value, backed by real financial strength, it's not an investment, it's speculation. So what is my first buy? The company I bought under 200. Is it actually a discount to intrinsic value? Or are investors just telling themselves a comfortable story? Under 200, Amazon becomes a valuation green light, not a popularity contest. In 2025, Amazon generated $716.9 billion in net sales with operating income of $80 billion, net income was $77.7 billion, and operating cash flow increased 20% to $139.5 billion. That is real scale and real profitability. AWS generated $128.7 billion in revenue, growing 20% year over year. AWS operating income was $45.6 billion. That is the margin engine inside the company. Amazon is no longer shipping boxes, it is selling infrastructure. In the fourth quarter alone, AWS grew 24% year over year, its fastest growth in 13 quarters. Advertising grew 22% year over year, so high margin segments are accelerating. Now, here's where the tension actually lives. Free cash flow decreased to $11.2 billion, down from $38.2 billion the year before. And the primary reason was capital expenditures. Purchases of property and equipment increased by $50.7 billion year over year. This is primarily reflecting investments in artificial intelligence, and management stated that they expect to invest about $200 billion in CapEx in 2026. That is an enormous investment cycle. Cash flow compresses today to expand earnings tomorrow. That's the bet. But if AWS growth slows while spending stays elevated, returns on capital will disappoint. And when a stock is priced for execution, multiple compression can hurt quickly. The debate isn't about relevance, it's about whether Amazon is overspending. Retail still carries real costs. Wages, shipping, international margin pressure, and occasional restructuring charges. So this is not a straight line story, but under 200, with my DCF value of 275, you're given a 38% margin of safety to tolerate that volatility. Amazon gives you room to be wrong, and that keeps investors in the game. In a disciplined portfolio, this is the core compounder: scale, cash flow, optionality with margin of safety. If you own Amazon or you're building a real portfolio like me, hit the like button. Now, the next one is different. The business may be even stronger, but the price is far less forgiving. And when expectations are that high, even small disappointments matter. Let's look at the company I recently bought under 400. Microsoft under 400 feels obvious. Quarterly revenue was $81.3 billion, up 17% year over year. That's double-digit growth at enormous scale. Very few companies this large are still expanding that quickly. It tells you that enterprise demand remains strong. Operating income was $38.3 billion, up 21%. Profits are growing faster than revenue. That means margins are expanding. Efficiency at this size drives serious long-term compounding. Microsoft Cloud revenue reached $51.5 billion, up 26%. Cloud is now the core engine of the business. This is recurring subscription-based revenue, and it is still accelerating. Azure grew 39%. That is AI infrastructure demand from real enterprises. At this scale, 39% growth moves the entire company. That's not hype, That's impact. Commercial remaining performance obligations increased 110% to $625 billion. That represents contracted future revenue, deals already signed, but not yet recognized. It provides visibility most companies simply don't have, and visibility lowers uncertainty. More personal computing revenue declined 3%. Not every segment is riding the AI wave. Parts of the legacy business are flat. Overall growth depends heavily on cloud momentum. Net income was boosted by $7.6 billion from gains on OpenAI investments. That is not operating improvement, it is investment volatility. If that swings the other direction, reported earnings swing too. Elite businesses rarely trade cheap and rarely forgive mistakes. When Azure grows 39% and cloud crosses $50 billion in a quarter, the stock doesn't get priced with much room for error. Under 400 with an intrinsic value of 653, we're getting a discount of over 63%. In any portfolio, this is premium AI exposure, high quality but priced for execution. Goldman Sachs is calling Microsoft a top growth pick. The AI expansion isn't slowing. It's embedding deeper into enterprise infrastructure. The real question is how much of that long-term AI dominance is already priced in. Now compare that to something very different, a company that I bought around $7.50. No trillion-dollar balance sheet, no diversified empire, no margin cushion. Just one core idea and a stock that has already been crushed. Microsoft is about dominance. The next one's about asymmetry. Let's talk about SoundHound. At $7.50, this is not a finished business. It's a company trying to prove that it can scale. Q3 revenue was $42 million, up 68% year over year. That's real acceleration. Through the first 3 quarters of 2025, revenue reached $114 million, up 127%. This is no longer a concept story. Revenue is compounding at scale. Management said, we expect continued hypergrowth to be coupled with a break-even profitability profile. If 2026 becomes the year losses narrow toward break-even, the valuation conversation changes. Markets reprice inflection points. Now, let's look at the upside case. In its February 24th, 2026 article, Simply Wall Street's most popular narrative estimates a fair value of $28.58. That's nearly 4 times the current price of around $7 to $8. That valuation assumes continued revenue ramp and margin expansion over time. If that growth path holds, today's price looks materially discounted. But here's the friction. That same article notes SoundHound trades at roughly 22 times sales. The US software industry average is closer to 3.3 times. That's a massive premium. At 22 times sales, you're paying today for near perfect execution tomorrow. If growth slows, if dilution continues, if profitability slips, that multiple compresses fast. Our DCF value is about $15.50, so a $7.50 entry point is a 107% return. They do have $269 million in cash, no debt, and runway matters. Enterprise AI adoption is expanding. Voice commerce is expected to enter production in 2026. The opportunity is real, but so is the variability. Amazon is operating strength. Microsoft is premium quality. SoundHound is conditional. And conditional stocks require conditional sizing. And this is exactly the kind of stock that we're debating inside the Win Like Wall Street community. Not meme threads, not blind optimism, real position sizing, real risk management. Because this one works if hypergrowth converts into profitability. It struggles if it doesn't. And that brings us back to the original question. Only one of these clearly fits the textbook definition of a great investment. One is priced close to perfection, and one might not qualify as traditional investing at all. So which one actually earns that title? If you click this video looking for one stock to buy, this is the part that matters most. A great investment is not just a great company. It is a great company at a price that gives you a margin for error. That's Amazon. Could AI spending disappoint? Yes. Could margins compress? Yes. But the business is proven, the engine is durable, and the price gives you room to be imperfect. In a portfolio, this is foundational capital. Now Microsoft. Microsoft is arguably the highest quality business of the 3. Elite growth, elite margins, elite positioning in AI. But price changes the conversation. At these levels, you're paying for continued excellence. If Azure slows, if AI spending normalizes, if expectations reset, the stock can correct, even if the business remains strong. This is premium exposure, high quality, less room for error. And then there's SoundHound. Smaller, earlier, more volatile. Revenue is accelerating, break even is possible, but it's not proven, it's not stable, and it's not foundational. If hypergrowth converts into profitability, it could reprice dramatically. If it doesn't, valuation compresses quickly. This is asymmetric speculation, small allocation, intentional risk.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
Now, here's why the distinction matters. Most beginner investors don't lose money because they pick bad companies. They lose money because they misclassify risk. They treat speculation like a core holding. They treat premium stocks like discounted bargains. They ignore valuation entirely. Those four filters mentioned earlier are what separate investing from guessing. They force discipline. They force you to think before you allocate capital. Amazon, Microsoft, and SoundHound can all make you money, but only if you understand what role each plays. Which one actually fits your portfolio? Is Amazon the disciplined compounder? Is Microsoft worth paying up for at this level? Or is SoundHound's asymmetry worth the volatility? Let me know in the comments below. If this helped you think like a Wall Street analyst instead of a headline trader, share this video and follow the channel for real Wall Street level breakdowns. As always, be relentless.